Good morning, everybody. It is 10:57 a.m. Eastern Time. We're going to get going in 3 or 4 minutes. Do me a favor, if you are here, if you are joining us, give me a quick note in the chat to let me know that you can hear and see me okay. And that said, we'll get going in just a minute. Good morning, everybody. Welcome to today's Series 79 review. Nice to be with all of you. I'll be on cam in just a second. It is 10:59 a.m. Eastern Time, and we will get going shortly. All right, it is 11 a.m. Eastern Time, so let's get to it. Good morning, everybody. Welcome to Saturday. Nice to be with all of you. Today is the plan for today is to do a Series 79 review. Let me know in the chat that you can hear and see me okay. Just let me know that I'm coming through loud and clear. Wait for one person to let me know. Awesome. Thank you, Avery. Appreciate that. All right, so here is the plan. We did a review yesterday. We're going to do another one today. Yesterday, we spoke about a couple concepts. So the goal today is to avoid repeating concepts. A couple things I want to flag off the bat as we go through today's content. So got a lot of questions yesterday on, can I cover Reg M, a green shoe clause, and syndicate covering transactions? Those were frequent questions. I also got questions on, can I talk about deferred tax assets and liabilities? These topics are pretty long and they can eat up most of an hour review. So I got up this morning, I thought, you know what, I'm just gonna make a few videos so everybody can watch them. I went and I recorded a great video, an exceptional video might I add, on deferred tax assets. It was amazing. Then I went to post on our YouTube page, and it turns out I had already done that before and I had forgotten that I'd already made that video. So if you go to our YouTube channel, you will see that there are already 2 videos up there that cover Reg M, a green shoe clause, and syndicate covering transactions. That's all one video. There's a second video that covers deferred tax assets and deferred tax liabilities. Both of these videos are less than 10 minutes. They're really exceptionally well done. The moderator, that's me, does a great job. I'm pretty sure I made some funny jokes in there. Different shirt, but you get the point. So if you would like a short review on those videos on our YouTube Series 79 playlist, you can go and watch those. So I'm not going to cover those today simply because I already covered them, and they were so good. In fact, I'd forgotten that I already covered it. So here are the topics I want to talk about today. What I'm going to talk about today, anything I don't get to, we'll get to tomorrow. And if we have time at the end, I'll take some questions from the crowd. I'm not going to be focusing a whole lot on the chat right now. because then you end up learning from my ear. If I'm looking at my chat here, you see my ear, and nobody wants to learn from my ear. So I'm going to focus mainly on the content, try to make good eye contact with all of you, and then at the end of a topic, I'll say, hey, does anybody have a question on this topic? Then you can roll things on in the chat. So the topics I want to cover today, I want to cover Rule 10b-18, I want to talk about pipes, and I want to clarify pipes versus Reg D, and saying it's a pipe versus Reg D is actually a little bit of a fallacy. It's a pipe under Regulation D, actually. And then I want to talk about some types of M&A deals, an asset sale, a stock sale, a 338H10 election, and I also want to talk about LBOs, and then finally we will finish off with some exciting discussion of fairness opinions. So let's get to it. So let's start with Rule 10b-18. Okay. What is Rule 10b-18? Rule 10b-18 deals with, what is this rule? It deals with share buybacks by an issuer. So if an existing public company like Apple or McDonald's, love McDonald's, wants to repurchase its own stock, it can do so under Rule 10b-18. Now, some of you have said, hey, Brian, what does this mean? What does it mean that it's a safe harbor? And just to be clear, the term safe harbor is never, ever, ever, ever relevant when answering a question. Anytime you see reference to the term safe harbor on a question, in your head, you should substitute the word rule. In your head, you should substitute the word rule. Technically, it's not a rule. Technically, it's a strongly recommended guideline. But as far as we care, it's a rule. So if you're answering a question and the question uses the term safe harbor, just substitute the word rule. And then you'll see, well, that doesn't matter, that word is insignificant when answering the question. That's correct. All right, so why does this rule exist? This rule exists because the SEC wants to ensure that the issuer is not repurchasing its shares in a way that will be manipulative to the price. So they're not basically artificially driving their price up via share buybacks. So in order to be within the confines of the rule, a few things have to be met. First, the SEC doesn't want the issuer repurchasing near the open or close of trading. Why? Because the opening and closing price have unique importance. So trades cannot be, repurchases cannot be the first trade of the day or the last 30 minutes of the day. Now there's an exception for actively traded securities. Those are the big boys, the big companies. For actively traded securities, I'm just going to copy paste here, repurchases cannot be the first trade of the day or the last 10 minutes of the day. Okay, so if you're Apple and you want to repurchase stock, you can basically repurchase up until 350. You can repurchase up until 350. Okay. And you have smaller companies can repurchase up until 330 with the market closing at 4 p.m. Eastern time. Okay. An actively traded security has $1 million average daily trading volume and a $150 million public flow. You're thinking, well, I heard that somewhere else. That's also a definition under Reg M. That definition is pulled from Reg M. So if you want to repurchase, you can repurchase most of the day except for the open or in the last part of the day, last 30 minutes or last 10 minutes, depending on the liquidity of the stock. All right, so the SEC doesn't want the issuer buying too much of its stock on a given day. Anybody know? Let me know in the chat. How much of their stock can an issuer repurchase in a day. Anybody know? Let me know in the chat. There's going to be a little bit of delay. Let me know. Max, an issuer can repurchase in a day. Repurchase in a day is, what do you think? There you go, exactly right. It's going to be 25% of the stock's normal daily trading volume. So you cannot repurchase more than 25% of the stock's normal daily trading value. Okay, so that's how much you can repurchase. Now, that said, for stocks that don't have a lot of trading activity, there are some stocks that don't have a huge amount of liquidity and don't trade a lot, so this can disadvantage certain issuers. So there's an exception. An exception. An issuer can repurchase, can do one block trade per week, and that's basically saying I have an unlimited amount, but no other repurchases that day. You can do one block trade per week, but no other repurchases that day. So an issuer on a given day, if they want to, they can buy 100% of their daily trading volume, but no other repurchases that day. It's got to be done in a single trade. And the point of that part of the rule is to give issuers a chance to do a significant buyback in the event that they don't normally have a lot of daily trading activity. All right. Now, the next part of the rule is the SEC doesn't want the issuer repurchasing shares just to drive up the price of the stock. Okay? So how do they do that? Well, if I'm an issuer and I want to repurchase my stock, let's say my stock is trading for 20 bucks, can I go into the market and just pay $100 to repurchase the shares and drive it up? Absolutely not. I cannot do that. So the way this works is the issuer can bid on its own securities, but no higher than the greater of the highest current bid or the last transaction price. So let me do an example of that. Example, company A, let's call it ABC Co. ABC Co. Current quote is 25 bid, 28 offer. 25-28, the first number of the is the bid, the second number is the ask, it's the current offer price. The last sale price, last trade price is 26. You can bid the greater of, you got to look at the highest current bid or the last transaction price, the greater of those two. So therefore, the issuer can bid, don't like the blue there, the issuer can bid 26. The greater of the highest current bid or the last transaction price. Now 28 is the current offer price. You can't use that price. These two, you have to look at the current bid, which is the number before the dash. You have to look at the last transaction price, which will be labeled, and it's the greater of those two. The greater of the highest current bid or the last transaction price. Okay, and one more thing, one more kind of bonus question that pops up on the exam on this rule is how long after an IPO can an issuer repurchase its own stock? How long after an IPO can an issuer repurchase its own stock? The answer there is 4 weeks. 4 weeks. It'd be pretty unusual to do a share buyback so soon after an IPO. Right? An IPO, you're selling shares to the public. Share buyback, you're kind of unwinding it. You're repurchasing some shares. So that would be an unusual case. Nonetheless, though, could be important for the test. Okay, so these are the salient points you want to know. And again, term safe harbor, never get focused or fixated on that term when you're answering the question. The question is never about that term, because there are several safe harbors, strongly recommended guidelines. You can just think of it as a rule. So basically, you can't pay whatever price you want. You can't repurchase at whatever time you want. You can't repurchase as many shares as you want. You're limited to how you can do all of those things. Does anybody have any questions on this particular topic, 10b-18? Again, what we're talking about here is share buybacks. Okay, while you consider those questions, I'm just going to get us ready for the next topic. Yeah, safe harbor is a rule. It's a rule. Yeah, sometimes it's rules together, but it's a rule. The word safe harbor means rule. 10b-18 is a safe harbor. No, it's not a set of rules that allows you to do things. It's just a rule. It's just a rule. Strongly recommended guideline. You can think of it as a rule, though. Okay. Basically, the SEC is saying you can do whatever you want, but if you comply with the safe harbor, we're probably not going to sue you for a violation of rules. All right, so I want to talk next about pipes and Regulation D. And specifically, the reason I phrased it this way is I get the question all the time, hey, Brian, what's the difference between a pipe and Reg D offering? I get this question all the time. This question is a flawed question, not trying to be critical of anybody who asked it, but this is a flawed question because they're related. So Reg D is the rule that permits private placements and outlines the contours and guidelines that issuers and broker-dealers need to follow. Okay? So if an issuer is going to do a private placement and the broker-dealer is going to facilitate or serve as a placement agent, that's got to be done within the auspices of Regulation D. So a pipe is a specific type of private placement. So is a pipe subject to Reg D rules or some other private placement rule like 144A potentially? Yes. So pipes are subject to the rules of Regulation D or possibly 144A if you're just selling equips. I'm not going to go down that rabbit hole now. But so it's not that there's a pipe transaction or Reg D transaction. That if you're doing a pipe, you have to comply with the rules. Those rules are found under Regulation D. Right, so let's talk about what is a pipe. What is a pipe? First thing that's important to know for the test is what it stands for. It's a private transaction in public equity. You want to be sure you don't flip those two around. It is not the opposite of that. It is not a public transaction in private equity. That is a poor answer choice. It is a private transaction in public equity, i.e., when a public company sells stock in a private placement. Okay, when a public company sells stock in a private placement. These were done by several banks during the financial crisis in 2008. Okay, why bother? Why bother? Right, if you're a public company, can't you just register an offering? Sure. What if you need capital really quickly? Generally used if a company needs capital quickly, right? So you don't have time to go through the registration process. You don't have time to go on a road show. You don't have time to market the deal. Also, or is possibly in distress and has approached specific investors, right? Warren Buffett in the 2008 financial crisis did 2 pipes with large public banks to shore up confidence. 2 benefits of that. One is because the banks only had 1 investor on each of those deals, they didn't have to register it with the SEC. That wouldn't make any sense. The second is by getting an investor like Warren Buffett, you're shoring up confidence in the business. So those were good examples of a pipe. Okay, so if you need to raise capital quickly, you want to shore up confidence, you're in distress, that's when you might see a pipe. Okay. Like all private placements, pipes are faster and cheaper than registered offerings. Okay. Now, so if I'm an investor in a pipe, so I'm Warren Buffett, I've agreed to help shore up confidence in the company by making this large investment. Could be equity, could be preferred stock, whatever. Am I going to get a liquidity event? Sure. Pipes will have hopefully a liquidity opportunity shortly after closing. How is that? Because it's a private placement, it's unregistered stock. how is it that I could immediately sell the stock? Well, the issuer agrees with the investor that it will file a registration statement for the shares shortly after closing. So basically, the issuer is saying to the investor, you know what? We really need this equity. Can we raise $1 billion? Will you invest $1 billion in our business, or $500 million in our business? We don't want to go through the registration process now because it's going to take too much time. We really want the equity. We really need the equity. But as soon as the deal is done, we'll get to work on filing the registration. So effectively, with a PIPE, one way to think about it is you're flipping. You're raising the capital first, so the registration statement doesn't become a bottleneck. And you can only do that because you're selling to accredited investors. You can never do that for an IPO when you're selling to the public. But you're selling to accredited, so you're saying, you know what? Can we raise the equity first? And I promise we'll get to go. And in fact, let's say they promise they'll file the registration and they drag their feet. If the issuer fails to file a registration shortly thereafter, it could be subject to penalties. Wow, the Microsoft Word AI is getting pretty good. So if the issuer fails to file a registration statement shortly thereafter, it could be subject to penalties. So again, a PIPE is done under Regulation D. You're raising the capital first, and then you are registering the shares immediately thereafter. And the benefit of a PIPE, like all private placements, is that the transaction is going to be shorter and cheaper than a registered offering. All right, does anybody have any questions about this topic? I'm going to prepare for the next section, and I'll wait to see if any questions come through in the chat. Okay. The next topic I want to talk about. I want to talk about some types of M&A transactions. I'm actually going to flip the order of these. I'm going to talk about a stock sale first, then an asset sale, 338H10, and then I'm going to talk about an LBO. Let's start with a stock sale. That's kind of the most straightforward of the transactions. So a stock sale is when the acquirer purchases the stock of the target company. Okay, it's when the acquirer purchases the stock of the target company. The advantages, it's usually the cleanest transaction from an accounting perspective. It's good for the seller because the selling shareholders will usually get the long-term capital gains tax rate, which is more favorable than ordinary income tax. So if they ask you, this is important on the test, if they were to ask you, what type of transaction should you pursue if the selling company shareholders are looking for tax advantages? For the seller, an equity transaction is best, because when I sell my stock, as long as I've held it for more than a year, I'm going to be eligible for the favorable capital gains tax rate. Now, an asset sale is when the acquirer purchases the assets of the target company. By the way, it also includes any liabilities that are attached to those assets. The key distinction here is legal ownership of the target might not actually change. Depending on what you're buying, it might, but it might not. So it could be that you're buying certain assets or a whole business line, but actual legal ownership of the company doesn't actually change. Okay? And the other benefit here, this is preferable for the buyer for tax reasons. Anybody know? Let me know in the chat. What are those tax reasons? What are those tax reasons? What are the tax reasons why the buyer, if they can, is going to want to do an asset sale? What do you think? There you go, exactly right. The reason is you get what's called a stepped up basis. You get what's called a stepped up basis. And what does that mean? What does that mean, a stepped up basis? It means the assets, yeah, there you go, a lot of good answers coming. Assets are written up, are marked up to the marked up to the purchase price on the buyer's balance sheet, which leads to greater depreciation. Depreciation is a wonderful thing because depreciation reduces your taxes. It leads to a stepped up basis, which means the assets are of more value, so therefore you get more depreciation, and that reduces your taxes. So it's preferable for the buyer for tax reasons. Okay, now you might not always be able to do so. You might not always be able to do an asset sale, depending on how complicated the transaction is. So what you want to connect here is you want to connect the terms. An asset sale is preferable for the buyer for a stepped up basis. So benefits the buyer. So an asset sale benefits the buyer by offering a stepped up basis. Those kind of three terms, you want to play some word association on the exam. Those three terms all kind of go together. All right, now let's talk next about a 338H10 election. 338H10. This is an equity sale, i.e. purchasing stock, but it is treated as an asset sale for tax purposes. So the buyer still gets to enjoy the stepped up basis and more depreciation. So it's an equity sale that for tax purposes treated as an asset sale. So you might describe this on the exam as an equity sale for GAAP, generally accepted accounting principles, an asset sale for tax. Now, you can't always do this type of transaction. It's generally only allowed with S corps, and there are other limitations. So you don't have to know the circumstances when you can or cannot do a 338H10, but you should know these points about it. And you also want to know the name of this rule. It's not heavily tested by the name of the rule, but you want to be able to recognize it. Now, that said, you don't want to confuse it. Don't confuse with 338H11. You want to be sure you don't confuse. No, I'm just kidding. That's not a rule. Just joking around, just having a good time. When you speak into the void for an hour, I got to mess with you a little bit, right? So 338H10 is an equity sale for GAAP and an asset sale for tax. Buyer gets to enjoy a stepped-up basis and more depreciation, and that's pretty much the story there. Let's talk next about an LBO, leverage buyout. Leverage buyout is a transaction. It's a purchase, an acquisition, with a small amount of equity and a lot of borrowed money. Anybody know what an LBO is exactly like? Anybody know? What's the thing? What's an LBO that happens all the time, that people do all the time? There you go. Exactly. Ann Claire, you got it. Bruce, you got it exactly. An LBO, buying a house with a mortgage. There you go. You got it, Griffin. Exactly. Thank you. With a mortgage is an LBO. Buying a house with a mortgage, that is an LBO. Right? If a house costs $1 million, you put up, for example, $200K of equity, you borrow $800,000, and you pay $1 million for the house, that is an LBO. You put up a little bit of cash, borrow a lot of money, you buy the house. In an LBO, you put up a little bit of cash, you borrow a lot of money, and you buy a business. It's the exact same thing. So what we're saying is we're borrowing a lot of money, and we're using it to buy this asset, and we're only putting up a small amount of the equity, 20%, 10%, whatever that is. Now, what's the critical feature in an attractive LBO candidate. What do you think? What are you looking for with an attractive LBO candidate? You're looking for strong cash flow. You're looking for strong cash flow. The acquirer would want to do an LBO, and you're looking for strong cash flow. And the question is, when would you look to do an LBO? Generally, financial sponsors are looking for LBOs. So private equity firms are doing LBOs. Strategic buyers don't generally engage in LBOs. That would be more unusual. Strategic buyers are looking for things like synergies. Like when Disney buys another studio, they're looking to integrate it, and they're looking for synergies in the business, and they're looking to drive revenue. In an LBO, what you're looking to do is you're looking to produce cash to pay down debt and take advantage of that leverage to get a solid return for equity investors, right? If you buy your house and the value of your house doubles, you more than double your money. I'm not going to go through the math of how that leverage works right now because it's not as germane to the test, but the whole idea is because of that leverage, you get all the returns. You get all the profits. You still got to pay the debt, so if the value of your house goes down, the bank's not going to give you a break on the mortgage. Same with a business. If you buy a business in an LBO and the value of the business falls, you still got to pay all that debt. But if the value of the business goes up, you get to enjoy all of those gains and all those profits. You're looking for strong cash flow in an LBO. You're generally keeping an existing management team in place. And one more thing. When would a target company consider a financial sponsor? That would be an LBO versus a strategic buyer. So I'm a company, this is important for the test. I'm a company, I want to sell. Sometimes I might just want to get the highest price. If you just want to get the highest price, you probably don't care if it's a financial sponsor or a strategic buyer. But when might I care? What do you think? When would I care? What would be my motivation to look either for a financial sponsor or a strategic buyer? So a financial sponsor, a sponsor, usually keeps the existing management team in place. So therefore, this is good. Therefore, it's a good liquidity event for executives who want to continue working. So basically, you're selling the business, you're selling control, but if you want to keep working, an LBO is a good place. A strategic buyer already has an existing management team. Therefore, it's a good liquidity event for executives who want to retire, right? So if I am a CEO and I want to retire, I want to sell and retire, if I sell to a sponsor, they're usually going to require me to work for a couple more years. If I want to retire, I can sell to a strategic buyer, right? If Disney buys a studio, Disney already has a studio. They have a management team in place. They're probably not going to need that management team of the studio they purchased. But if a private equity firm buys a studio, buys a movie studio, then they don't necessarily have a management team in place, so they're going to keep the management team from the studio. So the motivation about what is my future as an executive might guide, do I want to sell to a strategic buyer or do I want to sell to a financial sponsor? All right, let's, any questions about that topic while I prepare for the next one? All right. Let's talk next about fairness opinions. Okay, fairness opinions are a heavily tested topic on the exam. This is what I call a high yield topic. What does that mean if something is a high yield topic? The high yield topic means it's not a huge amount of content, it is a lot of questions. That's what you want, right? That's the kind of ratio you're looking for, right? When you talk about a ratio on the test to make it a high yield topic, It's not a huge amount of content and a lot of questions. And then, as an aside, by the way, other high yield topics, I'll just put this down here, other high yield topics, and if you've been to our training, you kind of know these hopefully already, but fairness opinions, exemptions from registration, equity research rules, pipes, those are kind of popping up on the exam recently, and FINRA Rule 5130, which deals with equity IPOs. IPOs, I'll get it right eventually. One more try. IPOs and restricted persons. Yeah, I'll probably talk about both exemptions and FIN Rule 5130 tomorrow. I talked a little bit about this today with private placements, but I'm going to talk about this one a little bit tomorrow. Equity research, I don't generally talk about in reviews because it's a page of content. It's not very difficult, and then the content you need to know about all those questions, including the nuances, is in the key concepts. So pipes I've talked about, fairness opinions I've talked about, I'm going to talk about now, exemptions, and FIN Rule 5130. I'll be sure to hit tomorrow's session. So fairness opinions, crowdfunding is not a heavily tested topic, no. And the critical elements to know are in the key concepts document. So what is a fairness opinion? A fairness opinion is an opinion of the financial fairness of a transaction. A fairness opinion is not an opinion on the legal fairness. It is not an opinion on the quality of the transaction or if the seller should do the deal. So in a fairness opinion, you're not saying it's a great transaction, definitely do it. You're not saying legally it's fair. What you're saying is a fairness opinion says the price being offered is fair given the fundamentals of the company and industry and other transactions in the space. So if it's an airline deal, you look at other recent airline transactions. You might do a DCF for the company. Okay? It's not saying, hey, it's a great deal. It's saying the price is reasonable considering what has recently happened in the space. Okay? A fairness opinion is usually written by a broker-dealer. It can be a broker, a BD, who was an M&A advisor on the deal. That happens all the time, and that's fine. You can advise on a deal and write the opinion, or the company could hire another bank. The company, by the way, if you're the advisor on the deal, the company would never tell you, go hire another bank to write the opinion. That would be crazy. If you're the advisor, you'll either be hired or your client will go out and hire somebody else. They won't tell you to go hire somebody else. That would be a little bit ridiculous. Each side of the deal generally gets their own fairness opinion. Okay. What are some elements of a fairness opinion? Okay, what are some elements or disclosures, I should say? Disclosures, elements or disclosures of a fairness opinion. Well, you're going to have a bunch of stuff in here. You're going to have, if the author is getting paid a success fee, meaning if you're getting paid specifically if the deal closes. If you're getting paid specifically if the deal closes. Now, what's not required as a disclosure? What's not required here? What do you think? Anybody know? I'll give you a second to think about it. What's not required with regard to the success fee? What do you think? I know there's a little bit of delay on the chat, so I'll give you a second or two. There you go, exactly right. The amount of the success fee. There you go. The amount of the success fee is not required. The existence of a success fee is required. The amount is not. If the author has done business with the client, yeah, both the buyer and the seller usually get a fairness opinion. That's fairly typical. If the author has done business with any of the parties to the deal in the last 2 years, e.g. underwriting work, other advisory work. Now, one exception though, if the author merely makes a market in the securities, that is not required to be disclosed. That is not a required disclosure. So if I'm advising Disney on a transaction and they hire me to write a fairness opinion, and I'm a market maker in Disney stock, that's not deemed a conflict that warrants disclosure. Okay. You have to disclose if the author has gotten independent financials and terms. This is not required, but the disclosure is required. So usually, for example, we are relying on the transaction terms provided by the seller. We have not verified if these terms are accurate. Okay. So we get the terms from the seller. We use those terms to prepare a fairness opinion. If those terms that they gave us are wrong, that's not my problem. I'm indemnified, meaning I'm not liable if they gave me crummy data. Okay, so you don't have to actually verify it. You just have to say if it was verified. You must consider if the author considered the fairness of comp to board members, and execs versus the comp to other shareholders. So basically, it could be the case that in a deal, the target company board and the target company execs have big severance packages or lucrative employment contracts. That happens, and that's fine. And the board, what the fairness opinion will say is, we did not consider these. In our opinion, we did not consider the fairness to the board versus other shareholders. And that's okay. You don't have to consider it. You just have to say if the author considered this, if the author considered it. Okay. Can an investment banker advise on a transaction and also help write the fairness opinion for the same transaction? What do you think? Can you advise on a deal and write a fairness opinion for the same transaction? What do you think? The answer is yes, absolutely you can. But the fairness opinion must be approved by who? By who? By non-deal team members on the fairness committee. All right, there you go, Niraj, you got it. Yep, exactly right. Very nice. So the a small working group at a bank prepares an FO, which is approved by a fairness committee. The fairness committee usually consists of a small group of MDs. It's possible. Is it possible? It is possible. I'm going to ask and answer the question. It's possible that a couple of those MDs actually worked on the transaction. That's fine. And that's okay. That's totally okay. But non-deal team members on that FC, Fairness Committee, must approve of the Fairness Committee. Okay, so you can have deal team members on the committee, they can review it, they can provide expertise, but ultimately non-deal team members must approve. Yeah. Brokers, one more thing about this, broker-dealers must have procedures to create fairness committees, including the qualifications of members of the Fairness Committee. Okay. So those are kind of your critical elements to know. Again, it's a couple slides in your notebook. If you have our notebook, there's a couple slides in there from the videos. Be sure you know those. Between this topic and the other high-yield topics, you could see 24 questions on the exam. It could be a full third of the exam. All right, so let's talk about what I want to do now. I'm going to talk about some critical elements to review for a couple minutes. If you have other topics, I'm going to hopefully give 10 minutes for kind of open Q&A now. If you have other topics, do me a favor, throw them in the chat. Don't give me 25 topics to review. Be thoughtful. Remember, I'm only going to have about 10 minutes, so if you give me 25, I'm going to get to choose. If there's anything specifically, then I will answer that. But as you consider those questions, what are the critical elements in your last, let's say, 48 hours of prep? Okay? So what do you want to be thinking about in that last 48 hours? And for those of you who have been to our training, I'm not going to say anything groundbreaking that we haven't said a bunch of times. So you want to complete all final exams with the benchmark exam no later than the morning before your test. So if you're testing on Monday, you would want to take the benchmark on Sunday morning. The benchmark does not need to be the final transaction, the final test that you complete. But you should do it, completing it in the morning gives you the chance to pivot. Okay. Lots of review of the key concepts document, okay? So, and I say, when you review the key concepts, you want to move fast and break, well, stuff. Move fast and break some stuff, meaning I'd rather skim it so you can read it 3 or 4 times before your test, right? The candidates who generally are successful on the exam are the ones who are saying, I've read it quickly, I've seen all those things 3 or 4 times. Every time it gets a little faster, because every time you're like, oh, I'm going to cross that out because I know it really well. The candidates who sometimes have a harder time are the ones who, the day before the test, saying, it's really dense, I'm reading really slowly, but I've only gotten through 10 pages. So I want you to read it fast, because if you ask me to choose, do you want me to read it fast 3 or 4 times, or really slowly 1 time, or maybe really slowly and not finish the whole thing 1 time? You want to read it quickly 3 or 4 times. Okay, so skim it so you can read it 3 or 4 times before your test. Do a review of your notes from the workbook. Review the Series 79 supplement, which it has like you have an IPO flow chart, key forms doc, key forms sheet, you have an M&A timeline. Those are all useful things to review. And then pay attention, keep an eye out for emails from us. And above all, trust the process. Wait, some stuff here. Some work. Trust the process, keep us posted, and don't go rogue. Okay, just the other day, I was having a conversation with somebody 5 days into their prep. The only thing they've done so far is read most of the textbook. And what they've left behind are the videos, practice exams, key concepts, and that's all going to have to be smashed into 24 hours, right? If you're spending 5 days reading the book and 2 days with all the other resources, you've gone rogue a bit and you haven't given the right respect to all the critical resources. So really important, ensure that your study plan is aligned with your timeline. What we see sometimes is candidates create a study plan that's really great, but it's a 1-month study plan. If you're taking the test in 1 week, a 1-month study plan doesn't work. A 1-month study plan only works if you have a month to prepare or close to a month to prepare. Okay, let's do a little bit of open, and by the way, content questions, ts@knopman.com. Also, 1 question per email, please. 1 question per email, please. Okay, if you send me a long email with a list of 10 questions, I'm going to tell you, do you mind resending as 1 per email? Because it's very hard to respond to a long list, especially if I'm on my phone. So, couple other kind of, as we have, 10 minutes of kind of open entry and responses. So, people are asking about the breakdown of the Fairness Committee. Usually some of the deal team members are on the Fairness Committee, but not all. It's really up to the firm. The firm is usually going to want to keep most of the Fairness Committee as non-deal team members. I'm going to do a lot of exempt transactions review in tomorrow's session. Tomorrow's session is going to be focused a significant amount on going through the exempt transactions. So I'm not going to do that today because it's not really a topic I can cover in 10 minutes. Highest yield, when is an independent underwriter required? That's a good question. When is a qualified, anybody know the answer to that question? Qualified independent underwriter. If you can't make tomorrow's review, it's as soon as it's over, it's posted. So you can watch it later. When is a qualified independent underwriter required in a transaction? What do you think? What do you think? The answer is any time there is a conflict of interest in an underwriting. So what's a conflict? When is there a conflict? By the way, when is there a conflict? Okay. A conflict occurs. A conflict is if the issuer is a broker-dealer, if the issuer is controlled by or affiliated with a broker-dealer. Okay, so let me give some examples of this. This would be, if the issuer is a broker-dealer, this would be, e.g., an investment bank going public. If the issuer is controlled by or affiliated with a broker-dealer, this would be Chase Bank. Chase Bank going public as like a spin-off because they're affiliated with JP Morgan. If the issuer is controlled by employees of a broker-dealer, and control means greater than 10% ownership. And if the issuer, if at least, this one happens all the time, if at least 5% of the proceeds, if at least 5%, remember public offerings, expansion are not important. If at least 5% of the proceeds of the transaction are being paid to a broker-dealer to redeem debt. This one happens all the time. A very common use of IPO proceeds is to pay off debt. Right, so let me give you an example. GoPro went public in, I don't know, just in case anybody's fact checking me on this, in circa, I don't know, 2010. The underwriters were JP Morgan, Citi, and Barclays, and most of the proceeds from the IPO were paid to loans that were issued by those firms. So by the way, if there's a conflict, can you still underwrite the deal? Yes. Any of these conflicts, just to be clear, do not require the underwriter to drop out of the deal. Okay, I just want to be clear on that. That's not a good answer choice on the test, that you got to exit the deal. That's not a good answer choice. Rather, if a conflict exists, the issuer must hire a QIU, qualified independent underwriter, qualified independent underwriter, to conduct due diligence. Period. That's it. So in the GoPro deal, Piper Jaffray, as it was called at the time, but it was called Piper Sandler, formerly known as Piper Jaffray, was hired as QIU. Okay, so they conduct due diligence, which means they are liable for anything untruthful or misleading. The existence of a QIU must be disclosed in the prospectus, but the disclosure is not required to be located on the cover. It can be elsewhere in the document. It's not considered such a significant conflict that it's got to be in the cover. Virtually every IPO has this conflict. Virtually every IPO has this conflict. Why not just use a QIU from the start? Because usually banks hire, issuers want to hire banks that they've worked with in the past. Right? If I have a close relationship with JP Morgan, they've loaned me money, or Citi or Barclays, I've worked with them for years on other deals, now I'm going public, I'm going to want to hire them still. I trust them. I have a relationship there. For me to say, you know what, screw this, I'm going to look elsewhere, it's probably not going to yield the best transaction for me. So I want to work with a bank who I trust, and I'm just going to hire a QI. This is not a big deal, by the way. This is not a problem. Virtually every single transaction has this conflict. Virtually every single transaction has this conflict. Okay, so there are questions about, I don't think that's circular logic. So the question is, what does it take to be a seasoned issuer? There's a question about seasoned issuer. Anybody know what's the definition of a seasoned issuer? What do you think? Doesn't look circular to me there. So a seasoned issuer has a $75 million float and has been an SEC filer for at least 1 year. Okay. The benefit, what's the big benefit of being a seasoned issuer? Anybody know? The answer is you can register securities on an S3. And this is much, much easier than using an S1. An S3, by the way, is called a short form registration. So you need to be a seasoned issuer to use an S3. And you need to be eligible to use an S3, which means you're a seasoned issuer. So it's not circular, maybe it's unclear, but basically it's saying you need to be a seasoned issuer to use an S3. And to be a seasoned issuer, you need at least a $75 million float, and you must have been public for at least 1 year. Question is, when is a fairness committee required? A broker-dealer is required to have a fairness committee when they prepare fairness opinions. It's a FINRA rule. Somebody's asking about a jump ball versus a fixed pot. That's not as important for the test. You can send us an email about that if you want to talk about that in more detail. A couple people asking about member private offerings. That's not an important topic on the test. It is part of the content outline, but it rarely, if ever, comes up on the exam. If you were to say, hey, Brian, what do they test on MPOs? I'll tell you, I'm not aware that it's ever popped up on the exam, so I wouldn't worry about that. Okay. Is a seasoned issuer and an accelerated filer the same thing? Interesting question. Same threshold. The The distinction is a seasoned issuer is a definition of the 33 Act. An accelerated filer is a definition of the 34 Act that determines your deadline for submitting SEC filings. So same numerical thresholds, they determine different things, and the more important one to know is a seasoned issuer. Okay, we have 3 more minutes if anybody else has any questions. And again, I'm going to see you all tomorrow, same time, same channel, literally same time and same channel. Tomorrow I'm going to talk about exemptions from registration. Somebody asked about the high yield math topics. I'm not going to talk about any math right now, but the high yield math topics, I'll mention that. High yield math topics, sorry, I forgot that one. By the way, in general, the exam is about 10% math. But the high yield math topics are going to be your your cost of goods sold, FIFO, LIFO inventory. Yeah, Bruce, I see what you're saying, but it's still not really circular logic. You need to be an issuer that's eligible to use an S3 is a seasoned issuer. So it's I see what you're saying, but as long as you get it, we don't have to belabor the point. Cost of goods sold, taxes, and always use marginal tax rate when given. It's just a quirk of the exam. Cost of goods sold, taxes, your PE ratio, I'm going to say your profit multiples. So that's going to be PE, EV to EBITDA, EV to EBIT, and EV to sales. Equity value, sorry about that, versus enterprise value. Sorry for the dogging. I almost made it a full hour. I made it 59 minutes without a dog barking. I took him out. We played a long round of fetch, and he passed out for 59 minutes of my review. Equity value versus enterprise value, and shareholders' equity. Shareholders' equity. Holders equity, i.e. book value. What about WACC? What about accretion dilution? Not heavily tested. These are fundamental valuation concepts. The most complex evaluation concepts, they're not tested. If you want to say, Brian, what types of math questions will I see? In lesson 2 in the videos, we go through tons of sample questions. Those are the types of questions that you will see, right? We don't just make up those questions out of thin air. We make them up based on trends on the exam and what's going to be important on the test. Okay. Yeah, there are questions in the bank on accretion dilution, on making adjustments in financials for non-recurring items. Sure, those are testable items, but if we talk about the high yield math topics, the ones that are most popular on the exam, these are those. That's not to say these are the only math questions. It's say these are the high yield math topics. Okay, crowdfunding, not a heavily tested topic on the exam. Couple things to know about it. You can find in the key concepts. I probably have too many practice questions on that topic. Yeah, these are largely calculation rather than conceptual. You could see conceptual questions on these high yield math topics, but they are largely calculation. All right, it is noon. I'm going to let you all get back to it. As you know, we've been very responsive on our emails to questions, so feel free to keep those coming. It's not your last chance to ask questions, but we're going to put a pin in this review. It is available immediately on our channel if you want to watch it again. If you want to hear my dog barking again, you can. That's at the 59-minute mark. But tomorrow we'll be back and we'll talk about additional concepts. Nice working with all of you. Thank you for your attention and your diligence. And keep up the good work, and we'll see you all soon. Thanks very much. Bye-bye.